Paper wealth feels abundant, cash feels scarce. That mismatch is the signal. Stocks celebrate, while funding demands a higher toll. It doesn't break right away, it erodes. Auctions, buybacks, and the curve will call it before commentators do. Stay for 3 warning signs that separate a soft landing from a hard stop, and why the quiet version bankrupts more families than the loud one. When policy rates moved lower, while inflation print stayed above target, markets didn't cheer growth, they priced strain. In 2007, credit spreads were calm in May. By August, funding snapped. That contrast is back. The mechanism works like this. Cheap debt issued in 2020 or 2021 rolls at higher coupons. The fixed interest rate this year. Interest costs climb. Cash flow thins. Buybacks slow. Balance sheets tire. The result? Fragility hides under rising indexes. Now the constraint is simple. The stock market is not the economy, but its plumbing now sets the cost of time for everyone else. That's the pressure point that bankrupts households without a headline. What changed? Look at what happened as the calendar turned to October 31st, 2025. The Treasury's quarterly refunding met a market still digesting a summer steepener. Real yields. The interest rate minus inflation stayed high into November. Term premium, the extra yield for long bonds, rose again. The equity rally kept climbing on fewer leaders. That mix isn't confidence, it's caution priced as momentum. Now the pattern echoed a familiar setup. In 1999, concentration surged while funding costs crept higher. In 2001, leadership narrowed before profits rolled over. In 2021, retail flows swelled while margin balances spiked. When those threads braid, stress follows. Then the arithmetic bites. Households hold most liabilities at floating or short terms. Corporates sold debt at low coupons. Refi windows now clear at richer yields. The maturity wall, lots of debt coming due at once, doesn't move. It waits. Why does that matter? Watch the timing on this. Primary dealers, the banks required to bid at Treasury auctions, can warehouse only so much risk. When auctions tail, meaning demand is weak at a Treasury auction, investors demand more yield. Equity valuations don't ignore that signal for long. The spread, the gap between two interest rates, between funding costs and earnings yield, is the fulcrum. The math doesn't lie. So far, the curve steepened as leadership narrowed. Coming up, how stock ownership concentration translates into financial fragility. Now follow the money. The top 10% of households hold the lion's share of equities. Their flows drive indexes. The median family holds far less. Retirement accounts add steady buy every 2 weeks. That forced bid supports prices even when breadth thins. The result, index highs can mask a weak base, then consider withdrawals. When inflation sits above 3% while prices rise faster in essential goods, households lean on credit. Card rates reset quicker than wages. That gap pushes cash toward minimums. Even small price air pockets in stocks force selling at the worst moment. That's when things shift. But this isn't about fear alone, it's structure. Passive funds track weights. Leaders pull more dollars by design. Buybacks tighten float. Earnings beats concentrate in a few sectors. When funding costs rise, those programs slow. The feedback loop softens the same flaw that passive assumed was fixed. What happens next? Look at what institutions watch. Dealer balance sheets, funding spreads, and auction outcomes. If dealers hold more duration than their risk limits, like in late quarter periods, they hedge through futures. That can pressure indexes without a headline. If auction tails grow by a few basis points for 3 sales in a row, it says capital is scarce at that price. The signal appeared early this fall. So far, structure funnels flows into winners, while funding grows tight. Coming up, the mechanism that turns equity calm into household strain. Now the mechanism works like this. Equity wealth feels liquid until it isn't. Margin rules force sales. 401k loans borrowing against retirement reduce future buys. Corporate cash once earmarked for buybacks must meet higher coupons. The policy mix matters too. Balance sheet runoff. When the Fed lets bonds mature without replacing them, pulls cash from the system. The result? Scarcer collateral, dearer money. Then watch the contradiction. Indexes set records while delinquency rates on lower tier credit rose this year. That pairing doesn't last. Either earnings broaden to validate prices, or the price of money decides. If money stays expensive, multiples compress first. That's the fork. Now pressure builds in a quiet place, the primary market. When initial stock offerings return while profits are flat, supply meets cautious demand. Add large secondary sales from private equity seeking exits. Liquidity stretches. Who's on the other side of that trade? Watch what happens next. Now the players line up. The Federal Reserve sets policy at meetings like December 10th to 11th, 2025. The US Treasury sizes supply at quarter-end refundings. The European Central Bank watches the dollar and euro rates. China guides credit pulses through its state banks. Each actor signals through numbers, not speeches. Then the tell showed up after September 17th, 2025, when the policy rate moved lower, but real yields stayed firm. That says the bond market doubts inflation vanishes quickly. If the cost of time stays high, equity cash flows get discounted harder. Prices can rise only if earnings widen. That's a high bar. So far, the bond market is not singing the same song as equities. Coming up, a historical map from 3 cycles that rhyme with today. Now history shows a pattern. In 1974, energy costs surged while inventories were high. Profits fell next. In 2008, credits expanded while collateral quality fell. When housing turned, the system seized. In 2022, long-dated bonds dropped with stocks. The classic 60-40 shield failed. The result? Households took hits from both sides. Then check this contradiction. After October 31st, 2025 refunding, issuance stayed heavy while payroll revisions reduced earlier job gains. Markets prefer rising profits with declining supply. They got the opposite. The math shows the squeeze. Now 3 forces collide. Higher coupons roll in, buybacks slow, ownership is concentrated. That trio is the small crack that makes big breaks. If concentration falls while demand for duration rises, leaders carry less of the tape. The index feels different fast. That's the setup. What changed? Now a simple analogy helps. Refinancing at double the rate feels like replacing a fixed rent with 2 rents. The budget breaks. For corporates, that is interest coverage. When coverage weakens, investment shrinks. Hiring slows. That path shows up with a lag. The pattern emerged again this fall. Then translate the plumbing. A curve steepener means short rates fall faster than long rates. If that comes with stubborn real yields, policy is looser at the front but tight at the back. Growth hopes meet funding reality. The result? A market that celebrates today and worries about tomorrow at the same time. So far, the setup mixes easy front-end money with tight long money. Coming up, the calendar countdown that decides which side wins first. Now the calendar carries weight. 3 dates decide the next move. November 14th, 2025 for consumer price data. December 10th to 11th, 2025 for the Fed's policy decision. And January 31st, 2026 for the next quarterly refunding. Watch those prints. They align policy, prices and supply. Then the cliffhanger sits right there. If November CPI holds above 3, while the January 31st refunding skews long and auction tails widen, the snap seen this month won't be the last. That's the conditional path markets are now sketching. Watch the timing on this. Now turn to the score inside equity microstructure. Breadth. How many stocks rise tightened during rallies? Factor leadership narrowed to large profitable tech. That's fine when money is cheap. It's fragile when coupons rise. The earnings yield must outrun funding. If it doesn't, the spread compresses. Multiples adjust, then zoom out. Interest costs for the federal government are tracking toward $1 trillion on an annualized basis. That number now rivals defense outlays. Scale matters because Treasury supply sets the base rate for everything else. If supply is heavy and private demand soft, yields rise. Equities price that math later if not sooner. Now look at dealers again. If Treasury issuance crowds balance sheets, dealers pass risk to end investors. They hedge with futures. Equity indices feel that subtraction. It is not a conspiracy. It is plumbing. The signal appeared in periods with repeated auction tails and softer bid-to-cover ratios. The result? Higher term premium, tighter equity cushions. So far, supply and balance sheets constrain both bonds and stocks. Coming up, the players' likely moves if conditions persist into winter. Now consider policy responses. The Fed can slow balance sheet runoff to add reserves. It can signal a lower path for policy. The Treasury can tilt issuance toward bills if longs are fragile. Primary dealers can demand more term premium before absorbing duration. None of these are free lunches. Each shifts pressure somewhere else. Then map corporate behavior. Management teams can cut buybacks to save cash. They can slow hiring or capex spending on big projects to defend margins. They can issue equity into strength to reduce leverage. These moves support balance sheets. They also dilute per-share metrics that powered recent rallies. That's when pressure builds in valuations. Now pass households. Wage growth slowed from its peak. Housing costs stayed high, credit lines filled. That mix limits fresh equity buying at the edges. The median investor becomes price sensitive, just as listings like secondaries and IPOs expand supply. The result? A market that needs perfect news to go higher. What happens next? Now the market will choose between two clean stories. One, earnings broaden and growth carries the tape while long yields ease. Two, growth slows while long yields stay sticky and multiples compress. The second story is the one that bankrupts quietly, not through a crash, through a slow bleed and forced selling. Then anchor the translators to keep the map clear. Coupon is the fixed interest rate on a bond. Auction tail is when demand is weak at a Treasury auction. Real yield is the interest rate minus inflation. Term premium is extra yield investors' demand for long bonds. Primary dealers are banks required to bid at Treasury auctions. Maturity wall means lots of debt comes due at once. Rollover is refinancing old debt with new debt. Spread is the gap between two interest rates. Yield curve is the relationship between short and long rates. Those are the dials to watch. So far, the dictionary of the plumbing is on screen. Coming up, the 3 warning signs promised at the start. Now the payoff arrives. 3-line dashboard for the months ahead. Funding stress. Watch auction tails and term premium. If both rise together for 3 sales, equity cushions thin. Breadth and buybacks. Track buyback announcements and advance decline lines. If buybacks slow while breadth narrows, leadership falters. Real yields versus earnings. Compare real yields to earnings yield. If the gap closes, multiples buckle first. Then keep the motif in view, follow the money, find the pressure. That line opened this story. It guided the middle. It closes now. Money is dearer. Pressure concentrates where leverage hides. Small cracks, big breaks. Now the calendar tagline, once more. November 14th, December 10th to 11th, January 31st. 3 dates, 1 story. Policy, prices and supply deciding who pays the bill. Then a final scorecard to keep it honest. Auctions, firm or soft. Real yields, rising or falling. Central bank flows, adding or pausing. Those 3 checks frame the next tape.